On that note, Harsha Upadhyay, the CIO Equities at Kotak Mutual Fund, joins us now. Morning, Harsha. Thank you very much for joining us. Well, first a word on the general market mood itself. Is 7,740 proving to be a decent kind of support for the market? Are you a buyer on dips?
Clearly, market lacks triggers on either side. It's stuck in a small range. As far as our interest goes, we continue to place our bets on some of the areas where earnings growth is still a little bit more visible than the overall market. Having said that, we are not really aggressively investing our inflows into the market. We are a little bit cautious in terms of investing. As we see more opportunities in case of volatility in the market, we would look at those opportunities.
Okay. Harsha, hi, good morning. So you said that the market is stuck in a small range now, but what about the lower end of this range? Do you see it hold the recent lows of 7,500, or is there a larger possibility of that lows breaking anytime soon?
See, it's very difficult to predict short-term market movements. Having said that, I think at lower levels there is definitely buying interest. The domestic institutions are getting decent inflows. EPFO money is getting invested in the market at all levels. So I would say that after having corrected maybe about 15% from the top, now the valuations look more reasonable. So to that extent, the downside should be limited in the market at this point of time.
Okay. What is the kind of flows that you're seeing for equities itself? Has it been as robust? Any dissonance because of the Bihar election result? Any increase in redemptions at all? Any sense of disappointment from retailers?
Absolutely no change in the pace of redemptions. We are not seeing any redemptions at all. I would say very minor. But yes, inflows have been a little bit patchy in the month of November, but I won't call it a trend, a new trend. Maybe it's because of the festivals and the holidays that we had in between. But if it continues, then obviously that should cause some worry. But at this point of time, it continues to be more or less okay.
Okay. Well, I was just going through some of your top holdings that you have in your funds, and one of them is Infosys. That stock has, been the talk of the town with the way it's fallen in this month gone by. Is there a degree of underperformance that could continue in Infosys, or is this a good time to perhaps be accumulating that stock?
Without getting into stock specifics, clearly the IT space has kind of disappointed investors in terms of the management commentary that has come out over the last few months. The second quarter results were also more or less in line or below market expectations. Given all this and the fact that globally the growth has been really scarce and the pricing pressure continues, we continue to believe that this sector is unlikely to really outperform the overall market, but there could be stock specific opportunities within this sector, and that's what we are concentrating on.
Okay, Harsha, let me pick at some of the themes that evolved over the late last week. The 7th pay commission. Now, most of the numbers are out. As a stock investor, what would you play?
See, clearly, the second quarter results were quite disappointing. At the bottom line, there was about 2% odd year-on-year decline. The top line revenue was, there was a degrowth, and this is a consecutive fourth quarter of degrowth in the top line. So while there is some benefit because of the expansion in gross margins, that's not really flowing into bottom line because the companies are unable to hold on to the prices. So to that extent, it was a disappointment. Going forward, we believe that it is going to be a gradual recovery. We are not really seeing a great improvement in terms of overall earnings, but I think because of the favorable base that we will have from December quarter onwards, if you remember, December, March quarters of last financial year were really bad. So to that extent, even if the next two quarters are average, because of the favorable base, it should look reasonable. For the full year, we are looking at about 6% earnings growth now. This has been toned down quite a bit. At the beginning of the year, we were somewhere around low double digits. After having seen first half, now we think that the full year growth is going to be about, say, 6% year on year.
Okay.
Even for that to be achieved, you will need about 15% growth in the second half on year basis. So clearly, I think the earnings momentum is still not picking up.
No, I don't know, probably I'd make myself clear. I was asking you, how will you play the pay commission numbers? Now we know that it is about a 1 lakh crore that will come in terms of arrears, in terms of pension and salaries in FY17. Is that going to be positive for any of the companies? Will it be negative for banks? Because some brokerages are saying that will mean perhaps no more rate cuts from RBI. Generally, as a stock picker, what are you buying on this theme?
Sure. I think we were quite well positioned for this urban consumption pickup. Already we are seeing some improvement in urban consumption, especially in passenger cars and some of the consumer discretionary demand. And with the 7th pay commission in place, I think this should see a little more pickup going forward. And the commodities continue to remain under pressure, which means that gross margins will continue to remain healthy for this particular sector. And accordingly, we are looking at automobiles, consumer discretionaries, white goods, some of the banks which are really enablers for this demand to really kick in terms of retail focus. So these are some of the areas where we are placing our bets today.
Okay. What about the cement space? You have a big allocation to that sector as well. And there are some news reports indicating that, you know, some of the non-coal mine auctions will begin soon. So there could be a lot of speeding up in activity in infrastructure, cement, etc. because of this. What do you think the long-term potential could be in the cement sector?
Cement is clearly one of the long-term bets that we have in our portfolio. The capacity additions have really dried up in the sector, which means that any incremental demand that's going to come into the sector has to be serviced by the existing capacity. The cement business itself has got consolidated in the hands of maybe large 5 or 6 players. So to that extent, in a scenario where raw material prices are under pressure and there is pricing power in the industry, which means that the profitability is going to remain quite consistent. At the same time, we are also seeing improvement in demand that's coming from building of new roads. As we have seen, the roads have been, the pace of road building has considerably increased over the last 2 years, which was in the single-digit kilometers per day. Now it has moved to about 23 kilometers per day in terms of new roads. Similarly, we have seen activity in the mines area, whether it is coal mines, iron ore mines, or some of the new mining approvals that you are talking about.
Okay.
So clearly, the activity levels are picking up, and we believe cement is going to be a great beneficiary from this activity level improvement in the overall economy.
All right, Harsha, we'll leave it at that. Thank you very much for joining us. So that's the view coming in from Kotak AMC. Even to reach that 6% earnings growth, some companies, or at least the market in general, will have to generate 15% earnings growth in the second half. There is a base advantage, but we will have to wait and see which companies are able to build on it, and whether urban consumption and urban wages, which clearly have been rising, are going to have any impact at all.